Boom. Andy Fenton.
Happy Friday, my friend.
Happy Friday to you, brother. We haven't, it's been a couple of weeks.
Yes.
Since, maybe 2 weeks since we got to sit down at a desk. Anyway, last time we chatted, I was driving and it was, we had Paul on. Last week I was away in the middle of the desert. I think you did a bit of hand solo action, but
a bit of live Q&A. Yes, just trying to keep everyone entertained, Jason. You know,
that's it. But here we go. Got a few regulars rocking on back to the show. Calvin, good to see you. Happy Friday, my friend. James, it's 1 o'clock. Happy Friday to you.
It is.
Ben's on the wines too. Well, that's awesome. And we've got someone dialing in, whoever that is. Good day to you too, wherever you are. Great to be with you again on the Wine and Wisdom Fridays. Fridays, we're back on Friday. It works. Afternoon, gents, from the amazing Diane. And there you go. Carolyn's in the house as well. So it's awesome. Good to see people jumping on, Andy. Plenty going on out there in the world, as we always do, folks. A little intro for anyone who's seeing this for the first time or dialing in or whatever. Andy Fenton, in the world of banking and finance extraordinaire, joins me tonight on my left, but on my right as I look at him. And all things finance, financial planning, super, structuring, trusts, tax planning, amazing brain, and a good stand-up guy also, and pretty handsome as according to current sources. And Jason Whitten in the world of property, 20-odd years helping property investors across Australia and New Zealand. And between the two of us, we've done a few things. And each Friday, we get together, have a glass of wine, and debrief the week, and maybe share a bit of hopefully, our wisdom of our two industries. Started in the middle of COVID, wanting to support our tribe, and continues on to this day, really enjoying the world of sharing and teaching and helping those business owners and property investors around Australia, hopefully with a little bit of wisdom when it comes to those things. So good morning to you, or good afternoon to you, Jim, and Graham. Evening. Graham's always with us. And here's the go. Still watching the crypto, Andy, slowly climbing. We'll talk. We might even do a few questions a bit later on about that one. As we roll in. But what we might do, Andy, if you're keen, because I know we were talking about a few things about what's in the news. I know you've got a couple of things on your radar. Why don't you kick off this week? What's in the news? What we do, folks, just before Andy does, I just forgot to say, we do it in 3 sections. What's in the news? We think there's some things you should know, and also questions. And Andy did a bit of the groundwork last week about getting a bunch of questions. So tonight we're going to dive into a bunch of those questions tonight. So stay tuned. Some pretty good ones on the radar across a bunch of people. So, but Andy, over to you, mate. What's in the news? What do you got for us?
Well, firstly, what's not in the common newspaper news, mate? A little birdie tells me that you're being seconded to do some pretty high-profile presentations here and there. It may not have made the mainstream press at the moment, but my sources tell me that you've been doing a bit of speaking in and around town, and I had to do some calculations to help write a bit of a bio intro. I was told that it has to be wanky enough to be able to suit the types of Collins Street bankers and Macquarie bankers of the world. So, mate, I might ask a few questions about that. But one of the things that interested me in giving a bit of feedback there is you and I have sort of looked back and gone, okay, well, in our respective careers, how much have we created as far as wealth is concerned for clients and things along the way? And we were always looking back on backwards numbers. But I was thinking, maybe what we need to do is go, what would those actual investments be worth in today dollar terms? Because they're pretty out there numbers just in what's been raised. And when I was listening and assisting in writing your bio, mate, without any puffery, the numbers were significantly within the big billion marks at the present day value of when those things were acquired over time. But rather than have a swinging competition, mate, tell me a little bit about some of these speaking things that you're doing around the traps at the moment.
Well, I got a bit of an opportunity to speak in front of, let's say, your historical peers, Andy, the banking and the developing and the infrastructure people in Brisbane. It was great. It was today. There's a couple of hundred people in the room, and really got a chance to sort of have a talk to developers, councillors, financiers about Brisbane and what Brisbane was about to undergo and where they see the vision of Brisbane going. So I got a bit of a call up for that today. It was excellent. I had a good time to, where it's not my natural wheelhouse, but I certainly wasn't shy about giving a bit of an opinion or two about where I see developers going wrong. Supposedly they were very nice and said it was great. So supposedly it was a good chat. It was fantastic to do that in front of some quite professional peers and get some really nice feedback as well. So it was.
You're nothing if not modest, from what I hear. And mate, I heard that the brief was we need to find somebody conservative who won't necessarily tell us what they believe. They're just going to toe the company line, and then they couldn't find anybody, so they came for you, mate. That's how the gig started. That's of course not how it started. It's mate, they're picking the cream of the crop, mate, and they couldn't have had anybody better there. So, mate, that is what wasn't in the popular news. But, mate, screening back out, there's a few things that are in the news, and the world is going a bit chaotic at the moment. And if we have a look at this, we've been able to see a couple of the new hotspots that have come up around the country. I love this little cartoon. Quite literally, some of the hotspots in and around our wonderful politicians out there. But for all of you, in all seriousness, who are with me in lockdown in Melbourne, Jason and I sending big hugs out to all of you. We do have some tips a little bit later on tonight, in order to be able to give you some help along the way, and we will continue to report on that, because this is how it all started. But if only those fires were burning a little bit harder in the cartoon and a little bit lesser on the streets, I think that we'd all be a little bit better off. But of course, the main topic of this week, Melbourne back into lockdown. What does all of that mean? And we'll come back to that later on with some of the tips, some of the government grants, let you all know. So if you are out there and you know business owners, then tell them to tune in, shoot them out the link, get them to come on board. If they've got any questions, please fire them into our chat box, because we will answer them. If not this week, we might even do it midweek throughout the week if the lockdown continues. We're here to serve from that perspective. So mate, may the flames on the politicians get hotter, and may they become less on the street. But before we jump into that, I thought we'd go to a bit of global news, so that we don't start off with the sort of the what's happening in Melbourne, because we'll sort of go into that in detail. But maybe a bit of lighthearted stuff at the moment. Your favourite company, or second favourite company, Jace, Tesla, down significantly today. 25,000 Tesla Model 3 cars clawed back due to safety concerns. Apparently, Jason, if you're not driving your car, then that car might drive off the road. And apparently that affects the share price of Tesla. You can imagine if Ford and all of these other companies were judged by the same metrics, then every single car company would be crashing. But quite legitimately, mate, two main reasons for the stock price coming back about 5% today or last night. First was 23,000 Tesla Model 3s. Quote unquote, I'm not 100% sure that's exactly the number. It's in and around there. Recalled due to safety concerns. And those safety concerns in some aspects do actually come from people not driving their car, autopilot amongst a few other things, but also, which is the reason why I've got Sir Joe up the top here. Sir is the name I've given him, not the name that he was given by anybody else. But that China have actually decreased the amount of Tesla cars that they've been purchasing from Tesla down in a big way. So we've seen some reasonable volatility in a love stock of yours, mate, which I thought you would be interested in. But
it's a good time to buy in, double down on Tesla. That's the go.
Just reminding everybody that this is not a stock tip advice. It's certainly not from Mr. Witten's side of the equation. But love Tesla. It's good. It's good to own. I do own some Tesla, and I haven't bought it for the perspective of expecting good profits out of it, even though we have got great profits out of it. I bought it just because I love the company and love the man, but I'm going to belt the man up a little bit later on today. But this is a really interesting one, and it goes to the geopolitical stuff that people ask us about quite frequently. But good old Joe, Mr. Biden, has blacklisted now 59, I think it is, 59 China stocks. So Huawei is in line with them, and a number of other big China stocks that have links to China. What's it called? Intelligence and military operations. So this will be a really, really, really interesting one to watch, because we talk about cycles, and when a debt cycle finishes, which is where we should be at the moment, you go through trade wars. You go through currency wars, you go through trade wars, then you go through real wars. But perhaps the real war is a little bit of a different beast at the moment. So this is something that it's not a currency war, it's not a trade war. It's actually a little bit of a war of intelligence and data. So maybe that is the new war that's going to be fought. 59 stocks, mate, 59 big names, and they're linked to China military or China intelligence gathering. It's going to be blacklisted in a month's time.
Talk us through, Andy, how they blacklist it. Explain that more. Like, I get the idea. Yeah, okay, they're blacklisted, but like they're not allowed to be traded on the stock market. You can't have access to them. They're banned out of the country. Tell us all what that means.
Well, I'm not sure that it's actually ever really happened to this level before. So I'm going to use a little bit of fact and a little bit of speculation here, because I've got other things that have been looking at a lot more in depth than this. But effectively, May 29th, January, February, March, April, May, June, July, August 29th, I think it is, 29th. Anyway, late August. That's the closing bell. So you can trade out of the stock. So in theory, these stocks should plummet, right? Because all American investors will no longer be able to trade in that stock. If you haven't sold out, you will hold that stock, but you will not be able to trade out of that stock in America.
Wow.
So big moves, and there's already a little bit of hustle and bustle, shall we call it, from China in regards to this, because you can see what's happening. It's kind of like, well, if you're going to have these stocks and they're going to be gathering data from US sources and they're linked to China military, and we're not playing nice at the moment, well, in that case, you can't have American funds subsidizing the operations of these companies. So it's a national security measure. That's the reason that they're able to do it. They wouldn't legally be able to do it commercially. It would be anti-competition, but pull out the old the national security card, and you can waterboard somebody. You can pretty much do whatever you want. No, you can't. I'll just say that you can't waterboard somebody, just in case there's some sensitive listeners out there that take what I'm saying for fact. But basically, when you bring out the national security card, when you're America, you can pretty much do whatever you want. So 59 stocks from China no longer traded in the US. That is a big one, mate. It's really, really interesting. Never seen anything like it before. Not sure.
Huge.
Yeah, but what those people, the conspiracy theorists, the cryptocurrency dealers, the people talking about hyperinflation, the people talking about geopolitical threats. I mean, you and I know that diagram. I'm not sure if you've got it on call, mate. The old data versus conspiracy.
Yeah, the data one. Give me a moment, caller.
But this, and basically, this is going to set people and the cat amongst the pigeons in a big way, because people are going to read into it a lot more than what is necessary to be read into it, because realistically, it's a strategic move and it makes a lot of sense. But the knock-on effects of this can be quite significant. So my tip on this is you're going to see some mass volatility in, what I call conspiracy. That's it. So I maybe make that the old big one. I love this, is that data is just data. And at the moment we're getting some of the data and we're giving you the information that's out there. And the information is the fact that, these stocks are no longer going to be traded. Now, it may well be that some people have the knowledge that can link a few of these points together that say, well, they aid US military, they gather data, so it's an intelligence company. So that gives you some insights, perhaps on the bottom left, that says that, well, if they're operating in in the US, then they're getting money from the US and they're gathering data from the US and possibly using it against them. And maybe that's the wisdom that then says, well, we should blacklist the stock. But the conspiracy theory starts with a point of data and goes, well, this probably could mean this over here. And the next thing you know, you've got a pink unicorn. So, mate, I reckon there's going to be pink unicorns flying all
everywhere
around the crypto world, the gold world, the futures trading, mate. We're going to see some fun in markets and in the conspiracy theory world. And I say that, mate, and some parts of it might be right, but I think that we're going to see some large volatility in what I call the media stocks. And here's a new one, mate, so that is now really starting to gain momentum. Do you know what the newest type of they're like cryptocurrency stocks? Do you know what they're calling high volatility, emotional kind of media traded stocks? They're called meme stocks.
Meme stocks.
And so for those of you who want to check out AMG, which is in the news a lot, it's been recently purchased by just got divorced, largest one of the Amazon, and who's the other one? GameStop, which is actually stores of gaming, like GA games in Australia. It's like that over in the US. And these stocks have volatility that's off the chart. Get 60% up in a single day's trade and then fall off the edge of a cliff based off tweets. So we now have the invention of a new stock out in the marketplace, and it is called meme stocks. Meme stocks, yeah. So and where they get this from, Jace, is this, and so for the cryptocurrency legends out there, cop this. This is absolutely what I've been talking about now for weeks and weeks and weeks, if not months. Check this shit out. Look at this. Bitcoin slides. Bitcoin slides after Musk tweets broken heart emoji for a token. Right. So let me give you the facts behind this. So Bitcoin slid, all right, after a tweet from Elon Musk apparently hitting a potential split with the largest cryptocurrency. The latest post from the billionaire to buffet the token's price, the coin dropped as much as 5.4% and was trading at 36,980 as at 7:05 a.m. London time. So it dropped 5.7%. 5.7% like that on the back of a broken heart emoji tweeted by Elon Musk. This is.
So you've talked about this. You've talked about this before, and you and I've talked about the speed of information and now emotion, right? The speed of information and emotion being communicated, being transferred into the marketplace is just at tweet speed, right? At lightning speed, and it affects it's affecting the market just in crazy ways, huh?
Mate, I reckon Musk is just sitting behind going, all right, I'll buy and I'll tweet a heart. All right, I'll tweet a heart. Let's see what happens there. I'll buy $1 billion and I'll tweet a heart. Let's see if I can make $7 billion out of $1 billion just by tweeting a heart. And the irony about this, mate, and I'll wrap it up. I know I'm being a little bit satirical, but the irony behind this is he was using bloody Twitter, right? So let's have a look at the most socially unadvanced, not advanced, barely advanced social platform that there is. Right, like Twitter.
Inappropriate. Yeah.
It's words that is in a data feed, right? There's no real complexity to it. So Musk is using a platform which is inherently not a technically challenging platform. Like there's not a lot to Twitter, right? And Twitter's been trying to figure out how do we reduce our reliance on advertising income in order for us to be a relevant, company. So a billionaire is using Twitter to tweet and potentially having massive $1 billion slides on cryptocurrencies, which are innately a complex, technology instrument. And he's using Twitter, which is kind of like the old E.H. Holden of the social world. And now Twitter has basically come out and launched Twitter Blue. Right, so Twitter Blue, my friend, is now the monetized version of Twitter, and I love this. So the monetized version of Twitter is that you pay, I think, $3 to $4 a month, bugger all, and so you can get these amazing benefits, Jason, amazing benefits. Let me list off the top 3. All right, the amazing benefits that Twitter is inspired and requested by users include the ability to bookmark folders, designed to help you organize your tweets more easily. Pretty astounding technology revolution there. Then number two, the ability to undo a tweet, which lets users set a timer of up to 30 seconds to be able to adjust the tweet that they send if they've made a mistake. So you can actually go back. The top 2 features, you can bookmark and organize it in a filing cabinet, and you can edit a tweet. And for that, you'll get $2 to $3 a month, and they will get that from, I reckon, billions of users around Australia, so they can organize and they can edit their tweets. The world is just a very funny place.
Mate, that's hilarious. I've been out in the desert rock climbing, and I haven't noticed any of this in the last week or two. So I'm glad you've been keeping an eye on it, Andy. For us, what's in the news?
It's just it's a bit berserk, isn't it? There's some real stuff going on at the moment. We'll cover off on that today, but it's amazing when news drops. It just drops. It's like these guys, all of us, they've had a bit of a desert holiday, right? So there's been nothing around for a little bit, no new news, and so they start creating it, and they've been creating news for, I don't know, about 2 or 3 months now. Do you reckon?
Yeah. It has. Okay, we got nothing. Let's find something. Let's scrape the bottom of the barrel. Let's stir something up. Let's have a sticky beak around. At the end of the day, you got to feed the beast, don't you?
When a current affair has a news article about somebody putting the bin in the wrong place on a neighbourhood street, you know that stuff's about to go berserk because you've got people looking in new places for news, and what you've got those people searching for it and creating it in different areas, and then all of a sudden it just explodes, and new releases come out because everyone sees an opportunity in the market to launch their product. So.
Yeah. Well, it's interesting. Whoever this is, give us a shout out in the chat. But this is a really interesting comment, Andy. Right? So the idea of cryptocurrency and blockchain and Bitcoin is to decentralize it and have it uncontrolled or not in control by governments and banking institutions, right? But here's the thing. Now it's controlled by influencers, maybe. Now it's controlled by the popular masses. All right, now it's controlled by, being popular. It's whoever said this, Karen, well, that's a great potential insight. Maybe it's one of those unicorns. Maybe that's a data point too far a leap, but I like that one. I do like that one at all. That's some interesting thinking, some very interesting thinking. Don't want to be controlled by governments, but hey, something's being controlled or influenced right now. Good work, Karen.
It's
good to see you.
The day that we're making stock decisions based on what happens on Married at First Sight is the day I'm leaving the industry. Right? That I'm checking out.
Arguably, Andy Fenton, that's the way it's been forever and a day. We've just never seen it at this speed. Let's say it. But it's an interesting concept, isn't it?
Well,
far out.
Look, well, the reality behind it, just as a quick, serious point in that, if you go to certain coins, like different coins are affected by different people and different segments, right? So if you go to Stellar as an example, they are affected by banks, by hedge funds, so on and so forth, because they're being utilized for that purpose. So it could be that you start to see some that they're influenced, but by different sectors and different people and different powers within those sectors. And then it's your choice as to whether you play in those areas of exchange. And because, there have been, Ethereum, Bitcoin blew up and they're highly volatile. Well, all coins are. But I was listening to, and I know that we get some comments in and around this, and Karen last week from Central Coast, jumping into some of the questions, said, what's your take on the crypto market at the moment? And I was listening to Justin Sun, who is the founder of Tron. Tron is a coin that's out there. And so listen to this for some statistics. Reasonably new coin in the coin universe. And it's gone from 100 million to 300 billion, 30 billion, and it'll hit 100 billion this year, estimated. Global settlements, which means that the exchange of money or the exchange of tokens or coins within this market has surpassed PayPal, the global PayPal exchange. So in Tron, which is not a big coin by any stretch of the imagination, the daily changeover in Tron coins is $10 billion versus PayPal, which is $2 billion a day. Now, so what's my take on crypto is that the amount of money being exchanged through this mechanism is gargantuan, extraordinary. But here's the thing. So is the amount of money that goes through a casino. A lot of people talk about, and I'm not saying the two are the same, not by any stretch of the imagination, but what I am saying is that when people talk about transaction volume as being a reference of quality, that is absolutely not the case, because otherwise one of the strongest commodities in the world is 27. Jason, bet on 27. I'm not even sure whether that number exists on the roulette wheel. But so take on crypto is still very much the same. If you get in with players and understand the underlying market. And another one was from Naomi Minogue last week, who said, how do you start investing in crypto? And my answer to how do you start investing in crypto is you start investigating it. You start reading about it. You start absorbing the knowledge behind it. You start understanding, why was Ethereum built? Why is it different to Bitcoin? What is Tron, and why was Tron built, and why is Tron better or different than Ethereum? Where did Dogecoin come from? Is it really a joke that started off? And for me, that is where you start. And it's not sexy, but if you really want to actually be an investor of any degree of qualification, you just got to do the groundwork, because otherwise you'll be creating. I don't know if you read
this one of recent times, Andy. I think I was sort of mentioning it to you, The Art of the Impossible. Excellent book, excellent audio book if anyone's reading. But, it just reminds me of if you want to know a subject, there's a really interesting way of getting involved. Do the research, read some popular literature, then read some very technical literature, get involved. It might take you 6 months, a year to understand the thing, but you're not going to be left behind. At the end of the day, we are absolutely at the ground floor, if not well below the ground floor of the world of digital currencies and stuff like that. It's here to stay. You and I, like it. It is. It is not arguable that it's going to go away. But what we can see when it comes to the value and the stability of something that we might call an asset right now, it's so volatile, so influential, so unpredictable. It's like, I wouldn't call it assets, but certainly I would call it interesting. Certainly I would call it something we should be learning, observing, and understanding as we go into the next decade. Because in the next 10 or 20 years, something somewhere is going to become the thing, the one, the something, or multiple of, and it's going to be pretty interesting when you see it. But at the end of the day, I like the idea. For me, is there are all interesting ways to create money. And, one of them could be trading in and out of cryptocurrency. One of them could be trading in and out of everyday currency, trading in, American dollars versus, Australian dollars versus New Zealand dollars, that's been around forever and a day. It's a volatile game as well. So it's an interesting one. It's probably a new, it's a spin on an old thing, but it's a new thing. But the fundamentals are still there at the end of the day. Don't bet the house on it, because, something going up or down 60% in a day, gang, that is absolutely insane when it comes to your wealth. I would go, listen, put 1% in there and get to know it, maybe. And the 99% put it in the slow and steady wins the race. For me, that's what I would do, at the end of the day. But it's good to see a few people dialing in as we go. We've got Kelvin. He's investing in 27. That might be a coin. G'day to Harry, big fella. Good to see you dialing in, brother. All the way from Sydney. Yasmin's here and saying hello. Graham's in. He's $200 in coin spot, and that's good. We'll see how we roll. And I reckon this is kind of true. It could be considered a form of gambling. I actually believe all share markets are a form of gambling, to be honest. And probably it's probably fast and slow gambling. But anyway, we could wax lyrical on those things all day long, I would think. But maybe I'll change gears here, Andy, for sort of what's in the news in the world of real estate. And one thing that sort of popped up this week, which I think is quite interesting, quite cool for all of us in the property investing space when it comes to what's going on out there, is, it's interesting times. The market, the property market right now is just a good news story everywhere. And, that's, other than one or two things that might be, my issues with lockdown in Melbourne, which are real, might not be able to show tenants through or whatever it is. Wow, gee, I tell you what, the prices are rising, and there's no sign of it slowing down anytime soon. And soon in the world of real estate is not 1 or 2 days when it comes to the volatility of, Bitcoin or some other, shares, maybe, Tesla or whatever, a couple of tweets and you lose 5% of your value of your stock. The world of real estate, for the first time in 30 years, is doing some insane things. Sydney median house price rose $40,000 in 1 month. That's a 3% rise. That's the highest single monthly gain in 30 years.
Wow.
And that's kind of cool. It's certainly not normal, gang. This is extreme, extreme abnormal. And, this is probably, one of these, it goes from what's in the news to things you should know. It is. You should know. If you've just started right now, this is not normal, gang. for those who are buying property, I've got people right now who've bought houses, like first home buyers, Andy, and my brother and his girlfriend are one of them. They bought a house for $489,000. The thing's almost worth $550,000. They haven't even completed it yet. And, what I hope is they don't think that that's normal. That's this moment in time is not a normal, market in real estate. So, but if you do have this happening for you, now's the time to have a little look at. I did a little live this morning, a little Facebook Live about equity lock, making sure as your property values go up, you can lock in some equity so you have access to liquidity when it comes to your real estate. Real estate can be you can have liquidity in two ways in real estate. One, you can sell it, but you end up with costs and taxes associated to the sale, or liquidity. You can equity release. You can increase your loans and have access to that money. You can do something with it. But it's an interesting time, Andy, right now. Melbourne and Sydney, even though Melbourne's in, was it the third or the fourth lockdown? The Melbourne prices are still very, very strong and rising. Also, the Sydney prices absolutely going gangbusters. And that's one of the things that I have a look at when we have a look at. We've got a pretty interesting person. Here we go. All right. I saw your face then, Andy. I saw your face. I'm like, what's Andy looking at? Somebody's done something weird. Weird on. Anyway,
there is some unique individuals out in this world of ours.
Yeah,
goodness, nobody can
that's
see it.
fantastic. I love that. I love that. All right, this is mostly a PG show. That's hilarious. Harry told us, right, there's a 15th lockdown right now. So anyway, thanks, Harry. It's good to see you keeping track. You'd expect the accountant to keep the numbers accurate, but away you go. Anyway, on with the show, Andy.
Please deploy. Oh, that's hilarious.
But you know what? It's just not normal. This is not normal real estate market. So, everyone, just make sure you don't look a gift horse in the mouth. You take a few easy wins when you can get them. But at the end of the day, Melbourne and Sydney specifically right now, absolutely charging along like there's no tomorrow. And that's one of the things that I love about those two markets. They're just powerful. They're strong and they can do good things. So, for those in the real estate space, make sure that you keep rolling. What are we missing? Sorry, Harry, mate. There was someone who was doing some very interesting commenting. We had to sort of quickly delete them and block them. But anyway, there you go. Thankfully, it didn't show up to everyone else. So there you go. But anyway,
I did take a screenshot just so I have proof at some point in time that actually just happened.
That's funny. We'll post that to the K2 community, Andy.
Yeah, what can happen while you're doing live? Just for those who are listening, we just had an inappropriate bomb come past our feed, which, while hilarious, was definitely not the general consensus of the highbrow humour that we share on this program, but definitely unsettling. So, mate, this might actually be a good chance, because I did promise everybody last week that we were going to jump into the questions, and we've already tackled some from Karen from Central Coast on the crypto side, and Naomi Minogue. Thank you for those questions, and keep them coming through. Especially, look, and I can't emphasise this enough, we're going to go and look at the government grant stuff for Victorian businesses soon. But please whack your questions in so that we can respond, and we potentially have time to research some of them as well. So there's a couple here, mates, that go straight into that. Is that Anne Misson asked, I hope I pronounced that right. In general, do you reckon that the banks are going to actually loosen their lending criteria? Because, and you would have listened to us earlier on, they were going to repeal the responsible lending legislation because it went too far. The government actually couldn't get that passed, so that there wasn't a full release on it. But mate, what are you seeing in the lending world at the moment?
Well, this is hot off the press, and so today, like I said, I got to rub shoulders with a few of the people in the world of lending, and it sort of starts out there in sort of developer lending, like the big end of town lending, and it sort of filters down into the consumer. And certainly, what we're seeing right now, what I saw hot off the press today, there are 13 lenders in Australia absolutely gunning for development lending right now, and extremely positive about the world of developing.
Geez,
so that's a big change.
That's
it's been 4 years. 3 or 4 years, Andy. Yeah. It's easily the development lending was on the nose. Certainly when the APRA changes came in, the LVR changes came in, the political murmuring about removing negative gearing came in. That sort of 2016-17 era really sort of rattled the lenders, and they were like, oh, not another GFC, right? But right now, like you and I have been chatting about for months, a lot of money out there, bank accounts and, bonds and other defensive assets are bloody, absolutely useless. Money's looking for a home. And the lenders need to put it to work somewhere. And Australia is considered significantly a safe place, a safe bet. I listened to Bernard Salt today. He's quite a good demographer, fantastic presenter. And he showed some very convincing conversations around each time we've had some challenges worldwide. Australia has been one of these safe havens for money and play people to invest, and it's flowing right now. So developers,
every other state apart from Victoria, because we've slipped to a AA rating because of our lockdowns, soon to go to a single A rating. But that's really interesting, and you're probably going to continue on this track. And if you are, just maybe pull this back to the tail end. Does that mean that we're going to see the reintroduction of mezzanine finance funds and second and third mortgage finance funds and all of these things that we've been told have been shitting on the nose because there's a lending crisis since the GFC? All of a sudden, these things are going to become mainstream again?
They are absolutely on the menu and very high on the menu, Andy. They're already in play. I think you just got to know who's in the know, but they will be mainstream. I'm calling it again. You and I are calling it live on Wealth, Wine and Wisdom again. Give it 18 months, 24 months. You are going to be seeing the rise, the golden child, the new kid on the block, which is the old kid on the block who used to be here. He was here before.
Oh, yeah, he was here before. Don't worry about that. He's a bit fatter and a little slower, but he's certainly coming around again. So that means good things for Macquarie. Macquarie operate the best in this space, and I reckon, and I know you won't reveal, but and I don't know, we haven't had this conversation, but I reckon that came from the nose of somebody who was in the Mac Bank, I reckon.
They're in the know. They're in the know. And, at the end of the day, bankers, what do? They have to put money to work at a very low risk, Andy. And, they've got all sorts of whiz bang whistles and things that they measure and whatever it might be. But it's hot off the press. They are on the bandwagon. They are looking to put money to work. And one of the things that we've always seen, as a property guy and working with lots of developers around Australia, those guys have to, jump hurdles, pre-sales requirements, debt coverage requirements, equity contribution requirements. And those three things for developers and builders were significant for the last 4 or 5 years. They were significant headwinds. And it's one of the reasons that our development pipeline in Australia has literally plummeted to record lows. But the lenders, they've dropped those requirements. You don't have to have so many pre-sales. It's gone from 80% in some cases now down to 50% pre-sales. Debt coverage. they used to have 100% debt coverage in pre-sales. So now there's a couple of the major banks saying, "Oh, we'll do 80% debt coverage in pre-sales." So that's pretty good. Couple of the second tier or the mixed lenders, they're saying, "Okay, well, you actually don't even need any pre-sales. We'll just charge you, 8% or 10% or 12%, as long as your project is in these locations." So it's very interesting. We haven't seen that for 4 to 5 years, Andy. It's back at development stage, and I believe it will flow into residential real estate owners and buyers in the next 12 or 18 months as well. I think that looseness will flow through.
If they start playing in that game, that you and I need to have a lot more of a chat about this off screen, but if they start playing in this game again, then there's a natural arbitrage between development and resi.
Yeah.
And then they can start to make money. They can bookend it. And banks love to bookend stuff, right? The reason why they're no longer in financial advice is because they can't take money on the way in and take money on the way out in 7 different places in between. But ultimately, banks kind of need to do this stuff. Sometimes they just go too far. But banks need to do this stuff in order to guarantee your deposits. It's this horrible cycle of codependence. But if we're seeing them potentially come into this, that means to me 2 things. There's an incredible ability to jump into the private finance area, probably for a period of 12 to 18 months, and then it's going to be back in the institutional world. And when it goes back there, then a lot of the lenders and the second tier funders are going to become 3rd and 4th tier funders. So they're going to become it'll be interesting to see the rates they come in at. But it also makes sense, doesn't it? Because if you're exposed at the front or the back end, which is actually the investors and the completed property projects of which they're financing now, which is the full value of the asset, then there's the potential that they can come in and finance at a far greater interest rate, but then potentially have the security of having the undeveloped asset that then they can choose the partners to then do the value add from. And they haven't been playing in that space, not on both sides, I would say for about 8 years, maybe longer.
Yeah, well, I mean, they were, that was kind of the bread and butter just prior to the GFC, right? And the GFC made, quite a mess of it. But I was chatting to one of the bankers today, and they were like, "It doesn't feel like the GFC at all." Like,
no,
the GFC
does. But this is an interesting point, right? Because the GFC didn't start a year before the GFC. The GFC started a decade before, and we're in very different times and very different velocity of money times.
Yeah.
But it's an interesting recalibration point, because when we talk about debt cycles, and you and I haven't talked about this since, when there was nothing to talk about, so probably Christmas. And so debt cycles, they're multi-generational. So we see stock market rise and crashes. We see property markets booms and busts, and property does do that, right? People don't believe me, but it does. Strip inflation out and then watch it, and it goes up and down, just like everything else. But the debt cycles are multi-generational, 50, 60, sometimes 150 years. And so supposedly we're at the end of a debt cycle. But if this is now being reincarnated, that would suggest that we've actually seen the end of the debt cycle. So I'm going to make a little suggestion here, and whatever day it is, funny 4th of June, that if this stuff,
call it out loud. Yeah.
If this stuff starts to take off at a bank level, and they're getting back into this playbook, that means that the debt cycle is now in a new cycle. And it means that it's in a faster developing cycle, which means that if you want to be a historian who looks forward, then you need to go a decade back from the GFC and start understanding how first, second tier mortgage mezzanine finance worked in the banking sector, understand Pyramid, understand a few other companies that came and went through those periods, understand MFS, that was been and gone and understand the
Babcock and
dynamics.
Brown, yeah. LM
Babcock and
Investments,
Brown.
yeah.
But understand how that actually transpired over that period of time, because, and literally just heard it here, so my brain's just mossing around. Like, but if that's what is genuinely going to happen, perhaps we're actually in a new cycle, but we just didn't realize that we got there.
And I think it's happened a little bit faster than everyone expected, Andy. Like, I was chatting with a few people, literally, in Australia anyway, everyone sort of woke up in February going, oh, well, the world hasn't ended. We made it to Christmas. January was pretty good. Like, let's crack on. I feel like the pace that's been set since February has just been absolutely manic, for a lot of us. But Harry's got a good question here. And Harry, this is a good one, mate. Thanks for shouting it out. It's certainly one that in my talk today, I was telling, the developers and builders listening in, absolutely, there are challenges for those builders and developers who do not have very clear lines of sight through to the completion of their projects when it comes to their delivery partners. And so subbies, materials, et cetera, et cetera. This is the hidden risk right now in the marketplace. My suggestion to some of the builders and developers, because I've seen this before, Andy, unfortunately, many years ago, just prior to the GFC, our world, my world positive, like we're the champion of the buyer. So we would go in and really negotiate hard with the developers and builders. We'd get good prices. And then in the end, the slightest headwind for the builder or developer, they wouldn't be able to complete the project. So I suggested today to all the developers and builders to build in at least a 3 to 5% price rise in their property prices for everybody's sake. Everybody's sake, because if they can't deliver on their projects, the property construction costs price increases are coming. Harry, it absolutely is going to be passed on 100%, no questions asked. It's already being passed on, and we're seeing some of our great developers already letting us know to expect price increases because the cost of construction and the risk of construction prices not being able to be controlled is just, they have to price it into their projects. So good question, Harry. But if you've got some builders or some clients, mate, I would be saying, gang, put your prices up 5% or don't do the project, because you might sell it out now, but you won't be able to complete it. That's, but Harry, happy to chat, mate, if you need at any time.
It brings up a really interesting point. And Harry, it's an absolute cracker of a question because there's another couple of questions that we had also last week. And I'm just trying to find the one here. There was David Lees who said, what are your thoughts around predicted US inflation 10 years plus? How will that affect New Zealand and Australia? What happens if the US go under, blah, blah, blah. But basically it's what do we invest in if inflation starts to kick off? But before we go into that question, there was a lot of inflation questions last week, Jace. It's interesting because property prices don't just rise because investors want to pay more for them. Property prices rise because it costs more to build the bloody things.
Yeah.
The material costs go up. And we know that we're in a period of time of prolonged supply chain disruption. And there's a great deal of uncertainty as to when that supply chain will come back online. If it will come back online ever to the degree that it was, who knows? It will, maybe. I don't know. I don't have that crystal ball. But certainly, down here in Melbourne, going through another lockdown, we sit here and we go, well, and here's the thing about you guys. For the rest of you Australian, you know nothing. Because you live in these little utopian universes that don't get affected by anything, and we call you the ignorant bunch when you live anywhere else other than Australia, other than Victoria. But and I say that completely tongue in cheek, but what I mean by that is that what we know here is we know that how quickly things can get out of control with bad regulation, and how quickly that can stop productivity. Now, when we look globally, we see this all around, and regardless of whether Australia's done a good job or not, or whether we've been lucky or not, if you look globally, they're not lucky, whatever the case may be. Now, that supply chain of timber to us, that supply chain of materials to us, that anybody who believes that they can see how that's going to run through, whether South America starts to export when they need to be maintaining it for themselves, anybody who tells you they know the answer to that is absolutely just smoking the ganja or something similar, because none of us fully know how that's actually going to transpire.
It's true.
But
yeah.
If you've got not enough property or not enough investment returns, because if the share market's doing the same thing, you get 0% interest rates, you get something in the share market, but you take this as a result of it. Same thing, right? So if we then go from a property perspective, well, yes, property prices are already going up from that dynamic, but they're also going up because the cost of actually producing these things is going up. And it's not going up for the reason that it has been for the last 20 years, because cost of materials was going down, cost of people was going up. Yep. Right? So the tradies were costing more, the property developers and the marketing and all that stuff was costing more, but the materials weren't costing more, they were actually costing less. So now we're in a period of time where potentially wage stagnation means that maybe the developers and the chippies and the builders and the concreters, maybe they get paid the same for the next decade. They don't have wage inflation, but the concrete becomes more expensive. The timber becomes more expensive. The steel becomes more expensive, and that means that properties become more expensive.
Yeah, and they're compressing, Andy. You're dead right. And also too for a long time, over a decade, the interest rates have declined. So the gap between the cost of interest and owning a property has decreased. So what's been able to happen is, wages have stayed flat because interest rates have gone down, and that's one dimensional. That's certainly not the only reason. But costs of the money's no cheaper. It can't get any cheaper right now. So what is going to happen? Like you and I have chatted about,
pay you to take some money from me. So here, Jason, here's $1,000. Can you please keep 100,000 safe for me? But that doesn't work out for too long.
Not for long. And it's an interesting concept. And you and I, you specifically have mentioned, a number of economies around the world that have, like low to zero bloody interest rates for many years, multiple, Japan and decades. I don't think it's out of the question that that's where we are right now. And until we get other things happening, it was a conversation today. One of the private funders, a private funding group, did a talk today, and they said, what we should see is interest rates go up, and the ability for us as fund managers to increase, our returns to our investors. And basically, they're saying, because the interest rates are so low, there's no returns in banks, there's no returns in bonds. They say we're actually having to drop our cost of funds to be competitive in the market, to place it in the marketplace, because there's so much money floating around. Like, we have to compete. We have to literally buy our way in to opportunities in projects because we can't place the money. There's more money poking around than is making sense at the moment. And so it's an interesting one, Andy. I'm very curious to see how it rolls out. In the short term, what's happening for property investors, it's a positive thing. And the share market, if you know where you're at and you're able to understand a little bit of value purchasing, you're getting a piece of the pie as well.
And look, here's the other thing, is that if inflation starts to run and it gets out of control, which goes to David Lee's comment, and you were talking hyperinflation, and you mentioned, David, a couple of names that I don't follow, so I can't talk to them and didn't get a chance this week to have a look at them. But when inflation starts to really kick off, typically the things that you look for are gold, because that's an inflation link. So people would say Bitcoin now. Okay, well, you know our thoughts on that. Bitcoin when Musk says good, and Bitcoin and gold when Musk tweets, a broken heart emoji. Commodities, and what we're seeing right now is commodities are actually increasing in value because the supply of commodities is so restricted. Wood, steel, so on and so forth. Blue scope has gone up, had a little bit of a bounce around more recently. So commodities, inflation-linked bonds, like if you honestly believe that inflation is going to go and start to trip like a car on NAS, on NOS rather, one of those little 4-cylinder cars, the little Lancers, and you trip that little sucker up and it just starts sucking, what's it called? The not carbon monoxide, but that laughing gas. You've got
nitrous oxide.
That's it.
I was wondering where you're going with that, Andy. I was like, how can I support you on this?
When a thought just starts and then it gets further away from you and you can't follow it. So inflation-linked bonds, because that means that you'll track interest rates as they go up. And here's the last one, and I'm not just saying this because I have my man to my left or my right, is real estate trusts and real estate, because grounded assets would tend to go up in those times of hyperinflation or inflation. But here's the one caveat, and I always say this, is that history doesn't repeat itself, but it's an incredible mimic. And it's when there's that flow-on effect where we go, inflation will happen. It's inevitable. When and to what degree, we don't know. So it is good to be asking these questions, and it's good to be planning and trying to understand it. But what you've got to be looking for if you want to be super astute, and I'm not saying that I'll see it, and I might not. I might catch it a little bit too late, or I might just catch it as it's already launched. But I will get it. But you need to be looking for the way that it's different from last time. And that's probably the best advice I can give anybody, is that when these things happen again, it's how was it different than it was last time? And if you can see the mimic, then you might be able to get on the really good side of where it's going. Because at the moment, you'd be looking at it, you go, well, it's not hard to say that it'd be hyperinflation. I'm not saying that it will be, but you look at property prices going up, you look at the cost of property production going up, and that the only thing that'll make property production go down will be deflationary wages. Or material prices plummeting. That's the only thing that's going to affect the property price here in Australia, because the demand is higher than the supply. And unless we start bursting out of the seams and going into desert or, outskirts, then we won't see that. So you've got to be starting to look at these other triggers to try and understand where it's at. And here's the thing is, if the banks start to get involved in mezzanine finance again, that is the beginning of interest rates starting to rise, because that's them being able to play in the middle of the yield. And when they start to play it, but it might be 5 years, could be 10 years, Jace. It could be a very long time. But the fact that they're thinking about playing there is a really interesting prospect.
Yep, absolutely. Well, probably a good opportunity to put a pin in it, Andy. It's 6:13 on a Friday night, so I think that there's a bunch of questions actually. We can circle these around for next week as well. We've got a couple of great questions here from Brian, another one from Alison, another one from Harry. So we'll put a pin in those guys, and we'll circle around for next week.
One more thing before we go.
Again. Yeah, go, Andy.
So for all of you business owners out there, or anybody who knows a Victorian and is going to give them a great big hug, because it's not easy going through these periods of time. There is a lot of BS that's going around in regards to the government grants and all of those sorts of things. What I can tell you is go to this website. I won't put up my face there, Jace, just leave it the way that it is, maybe, or whichever. But it's business.vic.gov.au/grants. You can read it up there, guys. If you're in here, do us a favor, drop this link into the chat of each of our various different areas, because we're coming to you from here, there, and everywhere. But here's the thing, is that it's not just for hospitality businesses, and it's not just if you are completely stopped from work. They are still working this stuff out, right? They still don't know exactly what this is going to look like as far as a support program. So if you know somebody who is in a small business in Victoria and then they're disrupted by this, please share this link with them. Please share this post with them. Tell them to go to the end. That's why we put it at the end. Just tell them to go right the way to the end so they don't have to listen to all of the amazing stuff. Thanks, Harry, for dropping it in the chat. If more of you can do that, drop that link in the chat for us. Go here. It is a place where you can get support, and ultimately, it's not going to be the solution, but maybe it helps you out just through these periods of, a week, maybe a week and a half. Let's hope that it doesn't go longer than that. But the government grants page, please go there, register your interest. It's more than just hospitality. It is if you are affected and you can't go remote. If you're affected at any stretch of the imagination and you can't fully do it, please go here, have a look. There are some other terms and conditions, but we're more than happy to answer some of the questions. Fire them off to me and Jace. I just wanted to put that out there as a bit of a public post before we put a pin in it, Jace, because small business, you're in it, I'm in it. We are the backbone of the Australian economy. We really should have more say than what we do, because we pay the politicians more money than any other sector of Australia, and we need more help than anybody else. And so please share the post with everybody out there who's a Victorian business owner. Get it in front of them. You never know. Just have the conversation, guys, because the amount of people who have come to Jason and I over the time of Wine and Wisdom when we brought this up right in the beginning, who said, I work with other business owners. We didn't know about these grants and we didn't think that we were able to get them. Just share it, because you never quite know. And if you don't ask, then there's a potential that a mate of yours may not be able to receive something that will be able to potentially help them out significantly. Please pass it on.
Absolutely, mate. Well said, mate. Well said. Absolutely. Well, folks, great to have you guys hanging out with us. Andy Fenton, brother from another mother. Fantastic to hang out with you, my friend. Add some value. Make sure you take care, folks, wherever you are. Give a thought to those who can't hang out and do the things that you're doing, maybe. The Victorians and others around the world, even though we live in Australia in a fabulous place, thinking of those who aren't in such a good place. So there you go, folks. Fabulous to be back in the saddle. Join us again next week. We're back in our mojo on Friday for Wealth, Wine and Wisdom. That's it from us. What do we say? What's the go?
Well, for now, it's good night from me.
And it's good night from him. Good night.
Good night.